Right now, over 1.3 billion people in China walk around without a credit card in their pocket, without cash in their wallet, and without a single thought about it. They buy groceries, pay rent, split dinner bills, purchase cars, invest in mutual funds, and tip street musicians, all with a single app. And while the West spent the last 15 years perfecting contactless cards and chip readers, China didn't just leapfrog our payment system. They made it extinct. The question nobody in Silicon Valley or Wall Street wants to answer is simple. How did we miss this? Here's what the mainstream narrative gets wrong. Most Western analysts frame Alipay and mobile payments as a tech story, a cool Chinese app, a fintech unicorn. They compare it to Apple Pay or Venmo and move on, but that comparison is like comparing a bicycle to the entire interstate highway system. What actually happened in China wasn't a product launch. It was a complete rewiring of how money, trust, and economic power flow through the world's second-largest economy. And it happened so fast, so quietly, that by the time Western financial institutions understood it, the game was already over. Let me show you the numbers that matter. In 2023, China's mobile payment transaction volume hit 537.5 trillion yuan. That's roughly 74.7 trillion US dollars. For context, Visa and Mastercard combined processed about $22.4 trillion globally in the same year. China's mobile payment volume is more than 3 times the combined throughput of the 2 most powerful financial networks the West has ever built. 3 times. And nearly all of it flows through just 2 platforms, Alipay and WeChat Pay. So how did this happen? To truly understand the Alipay revolution, you need to see 3 forces that collided at exactly the right moment in Chinese economic history. I call them the 3 invisible engines. First, the trust vacuum. Second, the infrastructure inversion. Third, the data empire. Each one built on the last. And together they created something the West still doesn't fully comprehend. A parallel financial universe that doesn't need banks, doesn't need cards, and increasingly doesn't need the dollar. Let me start with the first engine, the trust vacuum. Most people think China adopted mobile payments because the technology was good. But here's what's really happening beneath that surface-level explanation. China adopted mobile payments because trust was broken. When I was researching payment adoption patterns in Shenzhen back in 2018, a factory worker told me something I'll never forget. He said, "I don't trust banks, I don't trust cash, but I trust the app because the app shows me everything." That one sentence explains more about the Alipay revolution than any Goldman Sachs report ever will. In the early 2000s, China had a massive trust deficit in commerce. Counterfeiting was rampant, not just luxury goods, but currency itself. The 100 yuan note was so frequently forged that shopkeepers used UV lights for every single transaction. Credit card fraud was widespread, but underreported because the legal infrastructure to resolve disputes barely existed. And e-commerce? Forget it. Buyers didn't trust sellers. Sellers didn't trust buyers. Online retail was dead on arrival. This is where Jack Ma saw something nobody else did. In 2004, when Alibaba launched Alipay, it wasn't designed as a payment app. It was designed as an escrow service. The buyer's money was held by Alipay until the goods arrived and were confirmed. Think about that. The foundational innovation wasn't technology. It was manufactured trust in an economy that had none. This is 327 million users by 2013 we're talking about. Not because Alipay had the best interface, not because of marketing spend, because it solved the single biggest friction point in Chinese economic life, the question of whether you'd actually get what you paid for. And here's what matters about this. The West never had this problem at scale. Visa and Mastercard already provided buyer protection. Banks already offered dispute resolution. The trust infrastructure already existed. So the West never needed an Alipay. But that existing infrastructure became an anchor. The very system that made Western commerce trustworthy is the same system that made it slow to evolve. The weapon that was supposed to create strength became the weakness. And the second engine, the infrastructure inversion, is even more dramatic. It's the one that makes most Western analysts completely miss what actually happened next. So here's the second force at work, and this one operates completely differently from the trust vacuum. If the first engine was about solving a psychological problem, the second engine, the infrastructure inversion, was about exploiting a physical one. And it's the most counterintuitive part of this entire story. Most people think that advanced economies build technology on top of existing infrastructure. You had landlines, then you got the internet, then you got smartphones, you had bank branches, then ATMs, then online banking, then mobile apps. Layer by layer, logical, linear. But China didn't follow that sequence. China skipped layers entirely, and that skip is the single most underappreciated economic event of the 21st century. Let me show you what this actually means. In 2011, China had approximately 3.1 bank branches per 100,000 adults in rural areas. The United States had 31.8. That's a tenfold gap. Hundreds of millions of Chinese citizens, particularly in Tier 3, Tier 4, and Tier 5 cities, had almost no access to formal banking, no checking accounts, no credit history, no plastic cards, nothing. In Western economics, we'd call this a crisis. In China, it became the greatest market opportunity in fintech history. Here's what nobody tells you about infrastructure gaps. When you have nothing, you have no legacy system to protect, no installed base of card readers, no entrenched merchant agreements, no billion-dollar interchange fee economy that fights against disruption. Alipay and WeChat Pay didn't have to convince merchants to replace their existing terminals. There were no terminals. They just handed them a QR code printout that cost 6 cents to produce. A senior economist at the People's Bank of China told me off the record during a fintech conference in Shanghai that the central bank internally referred to this as the blank canvas advantage. Their words, not mine. While the U.S. had 11.2 million point-of-sale terminals locked into Visa and Mastercard networks by 2015, China deployed over 38 million QR code acceptance points in roughly the same period. The cost difference is staggering. A traditional card terminal costs between $200 and $800 to deploy and maintain. A printed QR code costs almost nothing. If you're finding this valuable, hit that like button, because this next part is where the real shift becomes visible. Think about what this meant for small merchants. A fruit seller on the streets of Chengdu, a noodle shop in a village outside Kunming, a seamstress operating from her living room in Guizhou province. These people were never going to qualify for a merchant account with a bank. They were never going to install a card reader. The economics didn't work, the paperwork didn't work, the geography didn't work. But a QR code? Print it. Tape it to your cart. You're now part of the digital economy. This is 17.8 million micro-merchants onboarded between 2014 and 2017 alone, according to Ant Group's own filings. 17.8 million businesses that went from cash-only to digitally connected in 36 months. No Western payment network has ever achieved anything close to that velocity. And this connects to something even bigger, and I'll show you in a minute. Because the infrastructure inversion didn't just change payments. It changed lending, insurance, investment, and credit scoring simultaneously. When a fruit seller processes transactions through Alipay for 12 months, that transaction data becomes a credit profile. No bank visit required, no collateral required, no credit bureau required. Ant Group's My Bank began issuing microloans using what they called the 310 model. 3 minutes to apply, 1 second for approval, 0 human intervention. By 2020, My Bank had issued loans to over 35 million small businesses with a default rate of approximately 1.5%. For comparison, U.S. small business loan default rates hover around 2.4% through traditional banks with extensive underwriting processes. Here's the uncomfortable truth that the Western financial industry doesn't want to confront. The entire credit card ecosystem, interchange fees, merchant processing, credit bureaus, reward programs, represents roughly $247 billion in annual revenue in the United States alone. That ecosystem employs hundreds of thousands of people. It funds lobbying operations. It shapes regulation. It is not just a technology. It is a power structure. And China just proved it's entirely unnecessary. Which brings me to the third engine, the data empire. And this is the part that should genuinely concern every Western policymaker who's paying attention. The data empire. This is where the Alipay revolution stops being a fintech story and becomes a geopolitical one. Because when you process $74.7 trillion in transactions through 2 platforms, you don't just move money. You generate the most detailed, real-time economic map any nation has ever possessed. And that map is power. Most people think data means ads. Google has data, so it sells advertising. Facebook has data, so it targets users. That's the Western model. But here's what China did differently. And this is the part that makes most Western analysts deeply uncomfortable. China turned payment data into economic infrastructure itself. Not a byproduct, not a monetization layer. The actual foundation on which new systems are built. Let me show you the numbers that matter here. Alipay's parent company, Ant Group, holds behavioral financial data on over 730 million monthly active users. That's not just names and addresses. That's purchase frequency, location patterns, spending velocity, savings behavior, investment risk tolerance, social transaction networks, and merchant loyalty mapping. Every scan of a QR code adds a data point. Every red envelope sent during Lunar New Year adds context. Every UA Bao deposit, that's Ant Group's money market fund that at its peak held $268 billion, making it briefly the largest money market fund on the planet, adds a layer of financial identity. When I was in Beijing last year speaking with a product manager at a mid-tier fintech company, she described it this way. She said, "In America, your credit score is a photograph. In China, Jima credit is a movie." That distinction matters enormously. A FICO score is static. It updates monthly maybe. It captures whether you paid your bills. Jima credit, Sesame credit, captures how you live, how you spend, who you transact with, what time of day you buy things, whether your consumption patterns indicate stability or risk. This is 617 data dimensions per user compared to roughly 22 traditional variables in a standard FICO model. That's not an incremental improvement. That's an entirely different species of financial intelligence. Stay with me, because what comes next changes everything about how we understand competition between economic systems. Here's what makes this a strategic weapon, not just a business advantage. When you have this depth of economic data flowing in real time, you can do things that no central bank, no treasury department, no financial regulator in the West can currently do. You can see inflation forming before it shows up in official statistics. You can track consumption slowdowns, city by city, district by district, block by block, before any survey is conducted. You can identify supply chain disruptions the moment purchasing patterns shift. This is precisely why the People's Bank of China accelerated development of the digital yuan, the e-CNY. And here's what most Western coverage gets wrong about the digital yuan. They frame it as China's attempt to compete with cryptocurrency. It's not. A senior researcher at Tsinghua University's Fintech Center told me bluntly, the digital yuan isn't about crypto. It's about reclaiming the data layer from Ant Group and Tencent. The Chinese government watched two private companies build the most sophisticated financial intelligence network in human history and realized that network was too powerful to remain in private hands. This is 261 million digital yuan wallets opened by mid-2023, with transaction volumes exceeding 249 billion yuan. Not because Chinese citizens were excited about central bank digital currency, because the government embedded it into stimulus payments, transit systems, and government salary disbursements. Adoption by design, not by choice. Here's the uncomfortable truth that almost nobody is discussing publicly. The West isn't just behind on payment technology. The West is behind on economic visibility. The Federal Reserve makes monetary policy decisions based on data that is weeks or months old. The PBOC is building a system where economic data flows in real time, transaction by transaction, yuan by yuan. Imagine trying to play chess when your opponent can see the board and you're reading about yesterday's moves in a newspaper. And this data asymmetry is accelerating, not narrowing. Because while Western regulators debate whether to allow Apple to open NFC chips to third-party wallets, China is already integrating payment data with healthcare systems, education platforms, and urban planning algorithms. So what does all of this actually mean when you pull the three engines together? The answer is more consequential than most people realize. Let me pull this together into one clean picture, because once you see it, you can't unsee it. The three invisible engines, the trust vacuum, the infrastructure inversion, and the data empire, didn't just kill credit cards in China. They created a completely new financial operating system that runs faster, cheaper, and with far greater precision than anything the West has ever built. I'm going to give this framework a name you won't forget. The zero-friction economy. Zero legacy drag. Zero permission required, zero separation between payment, credit, insurance, investment, and state visibility. It is the first economy in history where money moves at the speed of thought, and every thought is recorded. Now let's look forward. 3 scenarios are already playing out, and only one of them keeps the West in the game. Scenario 1, the slow fade, most likely if we do nothing. By 2030, Alipay and WeChat Pay expand aggressively into Southeast Asia, Africa, and Latin America via Belt and Road digital corridors. Cross-border volume on Alipay's world-first platform already exceeded 1.1 trillion yuan in 2023. That number doubles every 24 to 30 months. In 10 years, the majority of global retail and remittance flows in the global south will settle on Chinese rails, in yuan or yuan-pegged stablecoins. The dollar's share of world trade settlements drops below 40%. The US doesn't lose the dollar overnight. It dies by 1,000 seamless taps. Scenario 2, the great bifurcation, the path China actually wants. The digital yuan becomes the neutral settlement layer for all non-Western trade. Russia, Iran, Saudi Arabia, Brazil, India, everyone who wants to trade without SWIFT exposure, plugs into e-CNY wallets. By 2035, 38% of global trade is invoiced in yuan, up from 2.8% today. The West keeps Visa, Mastercard, and the dollar for itself, but it becomes the rich world ghetto currency, while the rest of the planet runs on faster, cheaper infrastructure. 2 internets were bad enough. 2 financial systems are fatal. Scenario 3, the American counterstrike, the only one that still works. The Fed launches a proper FedNow Plus digital dollar wallet in 2026, forces Apple and Google to open NFC to any licensed provider, and offers every American a zero-fee, interest-bearing CBDC account directly with the central bank. Merchants get 0.1% interchange instead of 2.7%. Within 5 years, the US regains pricing power and data parity. This scenario is technically trivial and politically impossible, which is exactly why it's the only one that can save the dollar's dominance. Here's what matters. China didn't beat the West because they copied us better. They beat us because they started from zero trust, zero infrastructure, and zero illusions about privacy. And in doing so, they built something we now have to live both with and against. The Alipay revolution isn't a fintech story. It's the quiet announcement that the age of Western financial primacy ended while we were busy arguing about reward points and tap-to-pay limits. If this video shifted how you see the world even slightly, do 2 things right now. First, subscribe, because I'm going to keep mapping these power shifts before the mainstream.